So, welcome, ladies and gentlemen, to this. This is the first in a series of 6 webinars that we will be running over the coming weeks. Today's session is on how to draft a letter of instruction. This recording is indeed a take 2, because the first recording, when we actually did it on Wednesday, the 10th of March, didn't work due to my own incompetence. So we're just running through it again so that we can send out this recording. There's a couple of housekeeping points which are relevant to this session, and that they are that as we're going to go through this webinar, we're going to be putting in some links on the slides. You should have had a copy of those links in your follow-up email. But we will be sending you them again with a copy of this recording, assuming all is well. Also, at the end of the webinar, I'm going to be posting a link to a SurveyMonkey questionnaire. If you would, it's 6 questions long, takes about 2 minutes. Your feedback is helpful because it helps us to reflect on and improve the webinars that we do. So today the topic is on letter of instruction. It was voted by you in an earlier survey as the most requested area that you felt you needed assistance on in your pension sharing work. It is 40 minutes long, will be a bit of a canter through, and you'll find that some areas perhaps aren't as detailed as you might wish, but if you listen to the whole series of our webinars, I think subsequent sessions will build on the information, so you'll have the full knowledge at the end of it. So just a quick agenda. The first agenda is BlueSKY. If you'll indulge us to have one slide on who BlueSKY are and what we do and what we don't do, that will be useful for people who haven't perhaps used us before. Then we're going to be talking about a letter of instruction all the way through the process from do I need a letter of instruction, and if I do need one, where do I go to, and what are the questions I ask, and specifically, I believe, what shouldn't you ask for. Got some examples as we go through today, and hopefully it'll help you understand the principles and the process of a letter of instruction. As all CPD sessions should have, your learning objectives from our perspective should be that it'll help you understand when you should recommend getting a pension sharing report, what are the questions you should ask, what questions are unhelpful in the process, and how to access a template as a bit of a start. So a brief introduction to BlueSKY. The first thing to say is we're chartered financial planners, not actuaries. We have a history of doing pension sharing reports since 2000, when the legislation changed and pension sharing was first possible, and since then we've built up a number of years of experience on how to do them. And the work we do is particularly based around the assistance that we can give from a financial planning perspective while we are producing pension sharing reports. We've become members of Resolution, and my co-director Rob Starling and I are what they call specialists, having been through the Resolution training. My other 2 colleagues who haven't got the training, haven't got the specialist accreditation as yet, are going through the process. The recent PAG report also refers to people like us as pension on divorce experts. So what we're good at, we believe that because of the financial input that we can give, we're good at case discussions. So we welcome law professionals to pick the phone up and discuss a case with us, particularly where there are some difficulties or various nuances about it that you want to discuss. We often input financial planning aspects into our pension sharing reports where we are asked to, and where it is helpful to the outcome for both parties, certainly in a single joint expert instruction. We have managed to maintain our turnaround. We'll discuss turnaround times in a little bit later, but being able to maintain turnaround times means that we have to be selective about the cases that we take on, and I'm going to mention a bit more about that in due course. Not only do we do single joint expert reports, but a lot of the work is shadow expert work, where we may be acting for you and your client on a single instruction basis, where you may need help through the process, or indeed you may already have a pension sharing report that you need assistance to decipher. And at the end of the process, we will help you, or can help you or your clients, through the implementation of what's been agreed and how the finances are shared. And indeed, it's not uncommon that one or both clients may become clients, financial planning clients of BlueSKY, to seek assistance with the rebuilding of their financial circumstances. So just one slide on what we don't do, and this has come about from the fact that we have more inquiries than we can deal with. So what we've done is we've looked at where do we feel we add most value in our pension sharing reports, and where do we and eliminate or generally turn away those cases where we don't feel we can add any more value than, let's say, an actuary can. So the schemes which we are currently turning away or referring on to actuaries are those where when you triage the case, it's often fairly evident the direction of the pension share, and where the pension share is going to come from a scheme that, when the pension credit is implemented, the only option is for them to come to become an internal member of the originating scheme, and those will be schemes such as Uniform Services, Teachers Pension Scheme, NHS, local government, and all those schemes. When they implement the pension share, the only option is what we would call an internal option, and that is that the recipients of the pension share will become an internal member of that scheme. To all intents and purposes, that's just a number crunching exercise, and in those instances, we would refer you to actuarial services. We've worked with many actuaries over the years, so would be happy to refer you on if necessary. So do I even need a report? Let's start with that right from step one. Well, what I've shown there is a picture of the PAG report. For those of you who might not be familiar with it, this is a report that came out, I would imagine, a couple of years ago now, and it really was the first guidance, joined up guidance on how pensions should be treated on divorce. What we're seeing is that it is already being used and quoted by a number of judges. It was put together over a very long period of time by a number of pension on divorce experts, judges, barristers, financial advisors, mediators, and so it's got a good a good reputation, or getting a good reputation as a guide for how to deal with pensions. So if we refer to the PAG report, then what we'll see is that they are recommending that if the combination of the cash equivalents are over £100,000, you should consider getting a pension sharing report, because you're into this cost benefit uh, 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 issue that over £100,000, it's beginning to look like it's worthwhile getting a pension sharing report from a cost perspective. The caveat are, and there's lots of caveats here, are that public sector schemes generally are undervalued, and therefore you may see a cash equivalent value under 100,000, but the benefits that that public sector scheme gives actually on the open market are worth a lot more than £100,000. So there's that to be aware of, and also to be aware of is that many schemes will have hidden benefits, such as enhanced annuity rates, guaranteed growth rates, or attached benefits such as life cover, and those might not be immediately evident, but often are apparent in personal pension type schemes, what we call defined contribution schemes. So looking under the bonnet there may be necessary. It's always useful to read judgments, and there's more recent judgments than those which have referred to the PAG report and the need to obtain a report. I think in summary, what you're looking at is where there are valuations that combine to over 100,000, and then perhaps a mixture of final salary schemes as well as defined contribution schemes. So if you've then decided that, well, let me just come back to disclaimers. That's an important point. So on the point of disclaimers, if your client then says, I don't want a pension sharing report, or I will have a pension sharing report and I only want to consider a number of schemes, then we would recommend that you get a disclaimer signed. Now, the PAG report initially did put a disclaimer in its document, but on its second draft of the document withdrew it under legal advice. We feel that it's still worthwhile having a disclaimer if a client declines getting a pension sharing report. Our view is that it's better that they sign something because it endorses their decision and perhaps makes them think a bit more. So we have put a disclaimer on our website, and you'll have the link in a while, which obviously you should take your own advice on, but we feel that it's a good start for your clients to consider signing. When you are considering getting a pension sharing report, you also might be a little bit worried that you're not sure what to ask for on it, which is what we're going to go through. There may also be a little bit of anxiety about, if you get one, will I understand it? And probably about 20% of the work we do is where you've already got perhaps an actuarial report, and you're not sure that you understand it, or your client doesn't understand it and they need some help to explain that. In all those instances, what we would suggest is that you pick the phone up, talk to one of the advisors which are noted there to talk through that particular case. We can give you guidance on how to approach matters. If one of us aren't there, then we do have a technical team as well who should be able to assist you. So the next point is, well, where do I find a pension on divorce expert? Again, referring to the PAG report in Appendix D, they listed the number of criteria that a pension on divorce expert needs, and it makes reference to people like ourselves, chartered financial planners and actuaries, and the necessary skills that they need. And now this is some kind of self-certification process. You might find it useful to refer to this, and perhaps in your letter of instruction also ask whether the individual you're asking to do the pension sharing report satisfies the necessary relevant criteria, on or in Appendix D of the PAG report. So that's quite useful to refer to. From a point of view of where to go, where to go from, where to go for to get a pension sharing report, then we would recommend that one place to start is the resolution website, and I've highlighted the link there, and this will take you to this particular page. And what we did is put our postcode in there, and under the service offering you put in financial professional, and that'll bring up people in your area. You can broaden out the area if you wish, because I think perhaps geography is less of an issue now than it used to be, but it'll list there the advisors who are registered on the resolution website who you might wish to go to. Unfortunately, those are the only that's probably one of the main areas to go to, of course, other than asking around your own community of family lawyers to see who they use and who they would recommend. So if we then talk about making an inquiry, often even before we get a proper letter of instruction, we get an inquiry. Now that might be by telephone or by email. We've put on our website an inquiry form, a quotation request form. Again, there's a link, and you'll find on our website there's a tab with solicitors. And downloads for solicitors. In particular, it's for family lawyers. So here is a quotation request form which will guide you through the relevant points. There's a section for free text, and you will be able to complete that on your computer and email it back to us, and we'll get you a quote. If you don't use our form and just want to send a quick email, then these are the most helpful questions, or the most useful information that we need in order to provide you with a quote. First of all is, well, what type of work is it? Is it a single joint expert, or is it just shadow expert help? Having the client's surname for reference purposes is always really useful, because we obviously get a lot of inquiries, and to be able to reference them properly is important. The ages of the clients and whether there's anything notable about them, for example, health, what their residency status is, anything else that you think might be necessary. And of course, what is the pension information or the asset information that is present, and that would be the name of the scheme, the values, or the cash equivalents, or if it's some other asset, what the value is, and or what the benefits payable are, particularly from pensions. And at that stage, that's pretty much all we need. The final thing is, well, what are you trying to achieve? What are your objectives? What do you want the pension sharing report to show you? And I've stated your objectives rather than questions, because one thing that we find with pension sharing reports is that we get some which are just a long list of questions, and it becomes evident that perhaps the objectives of what the family lawyer is trying to achieve aren't terribly clear, and because they're not, or perhaps not quite as sure as they could be, there's a rather long list of questions, and I'll come up with an example at the moment of that. Now, if you send us in an inquiry, we will come back to you within 24 hours with the cost that we are estimating, the timescale, and any comments we have that might make the output more helpful to you, if that's the case. Timescale wise, we are currently quoting, and have quoted for a long time, and are maintaining 4 to 6 weeks after we've got all the information that we require. So what I mean by that is, when we get an instruction, we will collate all the information that we need, and once we've got all that information, we will get a report out to you within 4 to 6 weeks of us receiving all that information. I've got an example here. It's a real example. It's a scan of a letter of instruction, or part of a letter of instruction we were given. The point here is, well, there's lots of points here. One of the main points is there were too many questions. Although there were 8 questions bulleted here, what we'll see is that in this particular case, nowhere did it ask for an equality of income question, which is something, again, I'll come on to in a while. But it was asking for a range of pension shares. It didn't specify which scheme we were to apply that percentage to, but it wanted a range of 5 different shares, and they wanted them based on the assessment of capital value, which again, the PAG report doesn't support. There is little assistance, as I'll demonstrate later, in asking for what level of income is generated should you share the capital equally. They asked also for some information on offsetting, what offsetting options were available, and an analysis of them, and any pros and cons. It felt like they wanted a textbook here on pension offsetting. In the next question, they asked for offsetting calculations to be dealt with in £100 cash chunks. Now, based on the fact that we assessed fairly quickly that about a 300,000 pension share would need to go from the husband to the wife to create equality of income, which is the premise we started on. If we were breaking that £300,000 pension share into £100 chunks, that would mean that there could potentially be 3,000 figures that we were producing. They also wanted pre and post marriage accrual, so ring fencing there, which is another 2 sets of inquiries. And you'll note that when the numbers I've applied on the left-hand side, as you go through them, they compound, so you end up with quite a significant number of calculations. In fact, the only question which was helpful was were there any issues which we felt relevant to mention on the production of our pension sharing report, and that's always a good question because it invites us to go back, and in this instance we did go back and said with the greatest of respect we wouldn't start here, because if you look at the minimum and maximum number of calculations you get from this, then this would require somewhere between 120 and 30,000 calculations, which of course is crazy. And what we've noted from reports we've done in the past is that if you create a table which has too many outputs on it, then you just get one person looking for a big figure and the other person arguing for the smaller figure. So it turns out to be that sort of exercise rather than actual achieving some sort of objective. So if that's not if that's an example of what you shouldn't ask, what should you ask for? And I've got a couple of examples here. First of all, the driving principle for sharing pensions should always be to produce an equality of income at retirement. And that's supported by the PAG report, and there's a reference there to the PAG report. What ages should we look at producing equality? Well, just to give you a range, we would suggest 2, maybe certainly no more than 3 dates for production of equality figures. The last date being state pension age, because that's when all pensions have come into payment. And just to give you an example of what I mean by that, is that if we have a pension sharing report where we don't include state pensions, then what we might have done is created equality of income from 60, but as soon as a state pension becomes payable at 66, what we've now got, because most state pensions between husband and wife will be different to some extent, we've now created a difference of income. Now, what we've done in this case, of course, is yes, we've created 6 years of equal incomes, but when they're 60, 66, if they've got a 30-year life expectancy, for example, we've created 30 years of unequal income. Our view is we haven't really done the right job. If we compare that with where state pensions are included, what we've done here, of course, is we've created equality of income in the long term. In the short term, there might be a difference of income, and we will show you this where relevant in a pension sharing report. And in this instance, one party had a higher level of pension from 60 to 65, and then it swapped round the other way. In actual fact, we do detail the difference of those incomes, and in this instance, they were not actually that far different. But that's why we would always recommend you include state pension forecasts. And while I'm on that, now you can get state pension forecasts online very quickly. There's no BR19 required. I can't remember the last time we used a BR19 or indeed a BR20 form. So you can get all of this stuff online, and it's something your client can do very easily. So go back to letter of instruction, what to ask for. If you want offsetting calculations, it's absolutely fine, but be specific. We're wanting to know what it is you're looking to offset, because there's so many different methods of offsetting. If you give us a bit of context, we will then be able to apply the most appropriate method of offsetting for your clients, be it a cash lump sum or share of equity. It might be that you're just looking to ensure that your client can generate an income of X thousand pounds at retirement or at whatever age. So that's again a very clear instruction. And we always suggest that you just ask for relevant commentary that will be of benefit to both clients if it's a single joint expert report, because then that enables us to add some recommendations if relevant. As a starter, to help you on your way, we've got a draft a letter of instruction on our website. Again, it's under the downloads for solicitors tab. It's not it's no doubt not the finished article, but it's a draft there for you to go through and edit. It's a Word document download for you to use. And if we're looking for the actual text, then it will be something along these lines. That, remember, the guiding principle is how do I share pensions to create equality of income? I've put here at the ages of 60, 65 and state retirement age, I want to look at sharing them that's fair and maximizes income to both parties. That's the job that a pension sharing expert should do. If you're adding the offsetting question, it might be that you're saying something like, if the wife wishes to retain X thousand pounds of equity in a family matrimonial home, how should the pension sharing one be adjusted to reflect this? So just on to a few bits about, well, what not to ask for. We often get asked to calculate the true market value of the stated cash equivalents. Now, if you've got a CE, let's say of 500,000, that's the CE. That's what we've got to play with. The fact that the true value is not 500, it's 700,000, is of academic interest only. It's of no relevance. It's of no relevance to the output that you know that. So we would suggest that if you really want to know it out of interest, that's fine, but of course it does add cost to the pension sharing report. Please don't ask for too many questions. Think of the resulting report you'll generate. I recently was asked to review an actuarial report that ran to over 50 pages, had 38 tables in it, and nobody understood it, which is why we were sent it to try and decipher. That's a great example of too many questions being asked. The output that came out was too challenging to understand. As I've mentioned before, having some kind of idea on offsetting what you're trying to achieve is very helpful because it guides us to the right methods to use. Generally, don't ask for division of pensions based on capital values. I've got an example coming up which will show why not to do that. We don't, as you'll find this across all actuarial reports, that they will look at sharing gross incomes. We don't generally look at the taxation that is applicable to each individual other than lifetime allowance issues. So this is where a pension fund is over a certain size. There are tax charges. What we find again in some actuarial reports is that they mention that there's a lifetime allowance issue, but they don't include that in their equality of income calculations, which we find curious because we think you should do. So where there are lifetime allowance issues, we will always comment on them and include them in our calculations. Ring fencing, so that will be pre and post marriage calculations. It's difficult to calculate. I'll be discussing this in future webinars, but in general, ring fencing isn't supported by the PAG report. Judges are now beginning to turn these type of cases away because certainly in needs cases, and most cases seem to be needs cases, as it states here, the apportionment of pensions according to the period of marriage or relationship is rarely appropriate in needs cases. So that's why we don't generally. We do the calculations, but we suspect that ring fencing is where it's requested by your clients, but it's certainly not supported by PAG. And as an example as to why CEs are misleading, here's just an example of a wife who's got a public sector scheme, that's final salary scheme or a DB scheme, and the husband has got a personal pension type scheme, what we call a DC scheme. And while I'm just a quick tangent to this is, if you are confused about what does DB pension mean, what does DC pension mean, what's final salary, what's a personal pension in relation to all of that, and if you're confused about that, then on our downloads page there is a one-page summary of the terminology used to determine what type of pension you're looking at. So hopefully that's a helpful guide for those who might be a bit confused on occasion. So anyway, going back to this, here we've got a final salary scheme, valuation 300,000, personal pension type scheme, valuation 300. You might be forgiven to say, well, let's just call it quits. You just keep your respective scheme. If you did leave things as they are, you would then end up creating, allowing the wife to have an income of over 12,000 and the husband an income of 6,000. So nearly twice the amount because of the different nuances of the way pensions and the way those valuations work. So sharing pensions based on the CE clearly can have some unintended consequences. And I think the thing there that you perhaps need to consider is, of course, the risk of the advice you give. And are you straying into financial advice, which, of course, you'll be aware that you shouldn't really be doing. And even if you did, and this was subsequently kind of unearthed, it might come back to haunt you. So there's just a bit of care needed there. I'm going to run through a case now and hopefully extract some relevant points from this. And this is a fairly straightforward case. And when we get a case to quote on, one of the things we'll look at is we'll do a quick triage of how this case is looking. And what we've got here is Transport for London scheme. It's a DB scheme, so final salary scheme. Husband's also got a self-invested personal pension. That's what a SIP is. And the wife's got a small teacher's pension scheme, and we've included the state pensions here as well. What you'll immediately see is that the difference in incomes is reasonable. So it's not too challenging to work out that the direction of pension share is going to go from the husband to the wife. Because of the direction of the pension share, what you'll note is that this value is irrelevant. We didn't really need to write off, and in fact, we wouldn't be writing off to get the CE in this instance because we don't even need it. What we need is this, which is what we've got. It's also then worth knowing that if this is the direction of travel, then we don't have to wait for up to 3 months to get a valuation from the teacher's pension scheme. We could ask the member to go on their portal and download their benefit statement. That may well be enough for us to get on and do the pension sharing report without waiting for extended periods of time. The other point to note here is that this final salary scheme pays these level of guaranteed benefits. With final salary schemes, there's no investment element. Really all the scheme is doing is guaranteeing a income based on service and salary that the member will get. What we do know from our rough calculation is if the individual wanted to buy these benefits on the open market, it would cost something like £175,000 to do. And therefore, we know that this scheme represents fairly poor value. So unless we have to, we won't share it. CE's 138. Open market value to buy these benefits through an annuity purchase would be about 175,000. So when we do our pension share, we will note that we're going to share this, or we're going to share this fund, and we're going to place some money from here into a new scheme which has been established for the wife, and the amount of money that goes is £183,000 from the SIP. That's a scheme that we're sharing. What you'll now see that we've created is equal incomes, which is the whole objective of the exercise. And as I said, that valuation has not really been of any relevance at all. So the summary of that is that knowing the true value of the scheme is normally of no help. Certainly with regards to final salary schemes. You need to trust the pension on divorce expert to generate the best outcome for both parties. The pension on divorce expert will know what the value of the true values of the scheme are. They'll know whether they should be sharing them or not. Their job is to produce a report that will give the best outcomes to both parties. Equalization of income should be the primary driver, as I've shown in that exercise, and that sometimes CEs aren't necessary, and of course that's what helps us to do a case in the most efficient manner possible, and keep it simple. The more permutations you ask for, the more confusing it will get. And what we find is that the more cases come back to us to say, you've done all this, can you help us further, because we've now got some other permutations that we want to ask, and the case can become quite challenging. If you want to speed up the process, which I think most people do, then hopefully you'll understand that you need to keep the letter of instruction as focused as possible and has got as limited number of questions as possible. We're very happy to talk this matter through with you on a case-by-case basis, and even your clients. So if you are happy that, and your clients are happy that they, I suppose individually or collectively, want to chat with us about the production of this report, then we're happy to do so, obviously on an impartial basis with appropriate telephone notes being kept, or meeting notes. Always think about, well, what information have you got that might help us, that might mean that we can get on and do the case more quickly. And of course, as I've referred to earlier, sometimes your clients can get the information very quickly, more quickly than we can. For example, if they've got access to their pension portal, can they download the statements and send us the statements, because they will be up to date and sometimes will be all the information we need. With some trepidation, I will say that we can sometimes do a report quicker than the full pension sharing report, depending on what information you have, because it's not uncommon that people pick the phone up and say, I've got a hearing in 2 days' time and I need a bit of assistance. And in some cases, we can certainly give what we feel is a more accurate guide or answer than a judge on the day who might stick his finger in the air and say it feels like this. So that's assistance we can give. If I'm coming to the summary, then I would say, look, hopefully you'll understand that we are here to seek help if needed. I think the best cases or the best outcomes we see are where we've been helpful, or we've been consulted throughout the process. Do use template. Have a look at what we've generated, but templates are useful. Keep the questions simple and focused, and obviously the number to the minimum. Welcome input from the expert. Read PAG. PAG's a good read, I suppose. It is a good read. If it's 50 odd pages, no, it's a long read, and if you do nothing else, then each section of the PAG report does have an executive summary, which on its own is a good guide. For those of you who haven't seen BlueSKY's pension sharing reports, this is what our reports look like, in the sense that we get to the answer as quickly as we can. So we'll get to this grid, which should answer your question very early on in the section in the report. You won't have to dig around too much. And I've shown you this graph before. Where relevant and where helpful, we will put in a graph of what the pension share has actually produced in terms of income profile, and on an increasing basis, we are asked for some cash flow modelling. And we've got, I'll be touching on this in my future webinars, but what cash flow modelling is it enables us to show the clients what they've created by the pension share in terms of, will the pension share that's been recommended provide sufficient income for your clients for the rest of their lives? Will they run out of money? And in some instances, where you see here, where there's red, this particular pension share shows that in later life they may run out of money. So it's a good discussion point to put into a report, but of course, only where we are invited to do so. That's just for reference, help from BlueSKY. That's the end of that webinar. As I've mentioned, be very grateful if you let us know what you think. There's a SurveyMonkey link down there. And as a reminder, the next webinar is on Thursday, 25th of March. It sort of builds on what we've been going through today, but it's specifically pension sharing, hints and tips, things to watch out for, different ways of doing things, which I hope will build knowledge further. So thanks very much for listening. Hope that was of some help, and hope that you'll come back and join us again for our next webinar.